Breaking news! Everyone, Jerome Powell and the Federal Reserve just made the biggest move of 2025. The VA officially cut interest rates. This is the moment we've all been waiting for, and it's going to ripple through every part of our economy. But what does a Fed rate cut actually mean for you, your savings, your loans, and your investments? Let's break it down in simple terms. First, let's understand why they did this. The Fed lowers interest rates when it wants to stimulate the economy. Think of it like pressing the gas pedal on a car. After a period of trying to cool things down to fight inflation, the latest data suggests the economy needs a little boost. Maybe job growth has slowed, or inflation has fallen below their target. By making it cheaper to borrow money, they're encouraging businesses to invest and expand, and consumers to spend. It's a signal that they're shifting from defense to offense. So, how does this directly impact your wallet? The most immediate effect is on borrowing costs. If you have a variable rate loan, like a credit card or a home equity line of credit, you should see your interest payments go down pretty soon. This means more cash in your pocket each month. For those looking to buy a house or a car, this is fantastic news. Mortgage rates and auto loan rates are likely to drop, making those big-ticket purchases more affordable. If you've been waiting on the sidelines, now might be the time to start shopping around for Now let's talk about the other side of the coin. Savings. If you've been enjoying those high yields on your savings accounts, money market funds, and CDs, well, the party is starting to wind down. As the Fed cuts rates, the interest banks pay you on your deposits will also decrease. So, while borrowing gets cheaper, saving becomes a little less rewarding. It's a classic trade-off. This might be a good time to reevaluate your cash strategy. Are you holding too much in a low-yield savings account? Maybe it's time to consider other options. This brings us to the stock market. Historically, the market loves rate cuts, or at least the idea of them. Lower rates mean companies can borrow money more cheaply to fund growth, which can lead to higher profits. It also makes stocks look more attractive compared to safer assets like bonds, which will now offer lower yields. We often see a rally in sectors that are sensitive to interest rates, like technology, real estate, and consumer discretionary stocks. However, a word of caution. The market often prices these moves in ahead of time. So, while the long-term trend could be positive, do you want to be surprised if there is some short-term volatility as investors digest the news and the Fed's future plans? In summary, the Fed's decision to cut interest rates is a major pivot. It's a green light for borrowers, and potentially for the stock market, but a yellow light for savers who have enjoyed high returns on their cash. For homeowners, car buyers, and anyone with variable debt, this is a welcome relief. For investors, it signals a new chapter for the market. The key is to understand how these changes affect your personal financial situation and to adjust your strategy accordingly. Don't make any rash decisions, but do take this as an opportunity to review your finances. Thanks so much for watching. If you found this breakdown helpful, please hit that like button and subscribe for more updates on how the economy affects your money. I'd love to hear your thoughts in the comments below.